Now let's discuss another option. As I mentioned earlier, you may have several, even a lot of loans by the time you leave school. You can consolidate these federal loans into a single loan called a direct consolidation loan. There are some advantages to doing this, including convenience, not having to track multiple loan balances. You'll also have a single payment, and you don't have to worry much about the interest rate changing, as your overall interest rate stays essentially the same since it's a weighted average of your current loans. You might also get a lower monthly payment. Now let's talk about the cons, and the big one is that lower monthly payment is probably because you've extended out the length of the loan. This could be fine if getting the most affordable payment is the most important thing to you. Any progress you've been making towards repayment plans or forgiveness programs like the ones we just discussed won't count anymore since the consolidated loan is considered a new loan. You also cannot combine loans that belong to a parent with loans that belong to a student. Students can only consolidate their own loans. Parents can only consolidate their own loans too. We'll talk more about that later. And we're still only discussing federal loans at this point. This doesn't apply to private loans. Now, if you want to pursue consolidating your loans, you can start that process conveniently online at the website shown here at studentloans.gov. You can fill out the online app, which takes less than 30 minutes, and there's no fee to apply. Another option is to refinance your federal student loans. When I talk about refinancing, I'm talking about paying off your federal student loans with a new loan from a private financial institution like a bank. If you've seen commercials or ads for services to refinance or consolidate your student loans, these are generally by private financial institutions. Now, there are some advantages to doing this. You might be able to get a better interest rate from a bank or a credit union. This alone could mean a decent reduction in your monthly payment, which in turn might allow you to make the same monthly payment you're currently making, but pay off the loan even faster. Another advantage over loan consolidation is that you can refinance any type of loan, including federal or private or a combination, into a new private loan. And if you had someone co-sign a loan for you, it might let you release someone from their obligation. For example, if you have a parent who co-signed with you and you're making payments right now, it might be nice to release them from the risk of being on the hook for it. There are a number of disadvantages too. Getting a private loan is going to depend entirely on your creditworthiness. If you don't have the credit history or the income to justify it, you might not be able to get the loan. You will also lose any federal loan protections and benefits that we just covered, like income-driven repayment plans, loan forgiveness, and deferment and forbearance, which I'll cover shortly. And because you might give up loan forgiveness or extend the loan out further, you could end up paying more in the long run. You'll want to carefully consider the trade-offs and what to expect out of your career path before jumping into a refinance.